You've probably heard the term diversified portfolio, but what is a diversified portfolio and what are the benefits? A diversified portfolio basically is a mix-up of stocks, bonds, could be cash and other fixed income investments, could be commodities, real estate, and even things like digital assets. It can also include sectors, countries, and other strategies that may be involved within your financial portfolio. Now, having a mix of all these things, maybe not all, but some of these things within your investment portfolio creates what's called diversification. And the amount of money that you have in each one of these asset classes is going to depend on multiple factors, such as your time horizon, your goals, the type of investment account that you're investing in, and things like that. So that brings us to our main question. What are the actual benefits of diversification? The first benefit is you don't need to worry about timing the market. So you never know which country, sector, stock, or even strategy is going to perform better year after year. And what I mean by timing the market is trying to choose which investments or which stock, which strategy, which sector, which country, which one is going to perform the best each year or every couple of years. Diversification limits the need for us to try to pick these things. It also allows you to keep a long-term perspective on your portfolio rather than having to worry about changing it every year. Now, to show the benefit of this, let's take a look at this asset class returns quill, which shows all the different asset classes and the returns each year. As you can see, there's colors scattered all over this thing. There's not one color or one asset class that's constantly on the top or constantly on the bottom. For example, REITs in the top right, in red, they were in the top or the best performer in 2021, but the worst performer in 2020. So we can see these colors scattered all over the place, and diversification limits the need for us to try to pick and choose which one's going to perform best or trying to remove which one's going to perform the worst out of our portfolio. In the middle, you can see AA, which is a asset allocation portfolio, which is essentially a diversified portfolio. And you can see that the white square is kind of in the center of this entire asset class returns quilt, which is what diversification attempts to do, is keep us in the middle, give us a little bit of everything so our portfolio is much more smooth from a return perspective. The second benefit is it optimizes risk. Having a mix of various asset classes within your portfolio, it smooths out the ups and downs on a daily or annual basis. The third benefit is differentiated return streams. So investments such as the stock market, for example, investments in the stock market rather, can move up and down drastically on a short-term basis. So if we add in different asset classes, which hopes give us different return streams, then we don't have everything moving in the same direction all the time. For example, you may have 3 different asset classes. 2 of them may be going up, but 1 may be going down. And that's what a diversified portfolio tries to do, is when some things are going up, other things are going down, and when some things are going down, some are going up. That helps you get these different return streams that overall smooths out the portfolio returns and helps you manage the risk of your portfolio and keep the returns smoother. That way you can hang on to it for the long term. And the fourth benefit is it improves investor behavior. And what I mean by this is it reduces the need for us to make emotional decisions in short-term events. So like I mentioned earlier, when the stock market can make big moves up and down, if you have a diversified portfolio, your portfolio is less likely to make these really large moves because you have a mix of different asset classes, which helps you behaviorally be able to control the portfolio better or control your emotions when things are not as great and there's a little volatility in the market. And that way we don't make emotional decisions, possibly get out of our investments at the wrong time, which ultimately negatively impacts the long-term performance of our portfolio. In short, this benefit can help you sleep better at night as an investor. So just to recap, the 4 benefits of diversification that I talked about today are: 1, you don't need to worry about market timing. 2, it optimizes the risk of your portfolio. 3, gives you different return streams. And 4, creates better investor behavior.